Hello, everybody, and welcome, Aspire. I wanted to start by thanking Sean for setting this up. We're very excited to be working with you guys, learning, growing, and teaching you all of the loan products that we have to offer. Tonight, as you know, it's going to be a Mortgage Monday. My name is Manny. I am a licensed loan officer, and I am the branch manager here at Merchants Property Solutions. I've been doing mortgages for about 25 years, and we're going to do a quick presentation on what we offer, products that we do, what our bank does. We're going to start with a slideshow presentation, which I'm about to put up now. And again, guys, what we'll do is I like to go through the presentation first. There is a chat enabled, so as your questions pop up, put them in the chat. We'll go over them. I answer all questions live. If I don't know an answer, we will get back to you with it. But there isn't too much that I don't know, or I can't give you a generality on unless it's a super, super serious question that I've never seen. But again, with that being said, guys, welcome to the presentation. Welcome to Mortgage Monday. My name is Manny. We're going to kick on the slideshow now. As you can see, Merchants Property Solutions, that is who we are. Okay, on to the next slide. Now, like I said, Merchants Property Solutions, we are located in Melville. We are a mortgage bank. We are a direct lender for all of our products, whether it's, you'll learn about non-QM tonight, whether it's our FHA product, our VA product, or a conventional product, everything stays in-house. So we are the judge, we are the jury, we are the end-all be-all. So whatever decisions are made, it is made by us in-house. And why is that important, team? It's important because of speed. It's important because we know the file. It doesn't pass through a lot of hands. So our success rate is better because we get to explain to the underwriters. We talk to our underwriters. And we're quicker because everything is in-house. Okay, so again, that is who we are. Merchants Property Solutions, fully licensed mortgage bank. On to the next slide. Programs that we offer. So we have your FHA. We have your VA. We have our conventional, and we have something called non-QM. So non-QM is what makes us different, because not only do we offer it in conjunction with your government loans, which are FHA and VA, and your government-sponsored loans or government-sponsored entities like conventional Fannie Mae and Freddie Mac, we also offer the non-QM, and we also underwrite the non-QM in-house. Other banks our size, what they'll do is they'll send it directly to the investor or the people that they'll sell it to when it comes to the non-QM, because they really don't know it well enough, but we do. So we underwrite it in-house, and like I said, it makes the file go much smoother, it makes the file go much faster, okay? And just to give you a few ideas of what the types of loans are, you have your FHA, all right? FHA is a loan that it's not the federal government's money, it's our money, and they just protect it for us. So it's almost like they're co-signing it. Same thing with the VA. It's just a different department that protects our money. So FHA is very aggressive. VA is even more aggressive with 100% financing, no PMI. FHA is also aggressive. FHA, you'll need a minimum of 3.5% down, but there is PMI. There is upfront PMI or MI, and there's also monthly MI. With a VA loan, there's only the upfront funding fee depending on where you are in your status. Sometimes it depends on first use, secondary use, or what you've used before on the funding fee. All right? Then you have your conventional loan. All right? Your conventional loan, again, all three of these first loans, very cookie cutter. This is what when you go into your Bank of America is, or you Chase, your JP Morgan Chase, this is what they're advertising. This is what they're putting you in. This is what makes their mortgage world go around, okay? They stick to the guidelines like we do, but they also have what's called overlays. So when you go directly to a bank like that, they may be a little bit stricter, but we're only going to stick to what Fannie and Freddie asked for and what FHA and VA asked for, okay? With that being said, guys, like I said, if you have any questions, go into the chat now. I like to just kind of fly through the presentation because we don't want to take all of your time tonight. We don't want to get long and boring, but we do want to keep it interesting. So, Tyler, next slide. Yeah.
Yeah, there's a slight echo because the little
How's that? Can you?
Hold,
How's that, Nick?
so just hold this up. to your mouth.
Perils of going live, team. On the fly. So you know we're live. You know we're not AI. We're not bots. We are the real thing. So as you can see, as many times as we've done this, there's always technical difficulties. We good?
Yeah.
Perfect. All right, so next slide. So conventional and government loans. All right, so you have your conventional loan and then you have your government loan. What's the difference? Conventional, like I said, is Fannie and Freddie. They make all of the rules and guidelines as to what can be traded and bought and sold on that market. Fannie and Freddie, what's called a government-sponsored entity. All right. Now, when you have a government loan, the government loan, they still make the guidelines of what they're going to insure, whether it's VA or FHA. They just don't lay out the money in either case. We always give the money, and God forbid there's a default, which we do not want, they protect us. So let's say, you know, the $1 million house, the loan was for $950,000. We were only able to sell it for $800,000. We would get covered from the government on the government loans. When it comes to conventional loans, you know, we're on the hook for everything. Okay? So again, that's conventional loans. Again, team, I do go fast. I do go over the slides, but if we have any questions, again, put them in the chat. Feel free, answer whatever you need to know, put in there. Okay, now, here's the meat and potatoes, guys. Non-QM loans. This is what has kept us going and opened up our markets and our client base, okay? Non-QM loans are very beneficial to the self-employment world. Why? Because it's alternative forms of income. None of our non-QM loans, so no matter who you go to, a non-QM loan, pretty much a fancy way of saying you're not following Fannie or Freddie or FHA or VA guidelines, okay? You're using alternative forms of income because you do need to show ability to pay, but you do not need traditional tax returns. So that's why it is so attractive to your self-employed person, because we all know when it comes to tax returns, they're entitled to a lot of write-offs. I mean, how many times have we seen the business doing 10 million, they write it down to maybe negative 100,000, and they can't get a conventional loan because by the time they put in their add backs, they're only maybe making 50,000 that the government sees, or the bank like us would see, and they can't afford that $1 million house. When it comes to non-QM loans, which we're going to go to the next slide, there's a few different ways we can prove income. And again, no tax returns, none needed. We don't care if they filed. The only time not doing tax returns poses an issue is if there's an actual tax lien against the person. So if they haven't filed for 3 years and they're still working on their taxes, or they haven't paid the bill, or they're in a payment plan, if they're not in a lien, it's okay. We don't want the tax returns anywhere near or around or even in the same building as the file, because it can kill the deal. That is why we have alternative forms of income. All right. The most popular one by far is the 12 months bank statements. And it is exactly what it sounds like. We use 12 months bank statements to prove their income. So for example, somebody's doing $1.2 million a year. They're averaging $100,000 a month. I would give them $50,000 a month on the application to work out their debt to income ratios. Now, debt to income ratio, you all know, is very important when it comes to buying a home. It lets the bank know, like us, if we can afford it. So if we were using their tax returns, they might be negative every month. Using their bank statements, I'm positive $50,000 a month. So again, that's why we call it the self-employment loan. That's why it's so important to the self-employed world, because they don't have a lot of options when it comes to mortgages, or they're always approved for something, just not on the income that they truly make. So if they want that $1 million house, on paper they can't afford it with a conventional loan, but with a non-QM loan, they could afford it. All right? So again, by far, proving income, bank statements, almost all of our self-employed people opt for that because it's much easier and the path of least resistance. Now, if you're a seasonal place, or maybe you made a lot of cash makes it to the bank, or just it's easier to do a profit and loss. So we could use a profit and loss instead of the bank statements. Profit and loss, again, just like it sounds. We're using a profit and loss. We're taking that bottom line, not the top line, bottom line, dividing it by 12. That's their income. All right. So again, if it shows positive 120,000 for the year, we're giving them 10,000 a month as income on that application to figure out their debt to income ratio. On to the next, DSCR, which stands for debt service ratio. It's strictly on investment properties. It's using, and it's the closest thing we have to a no documentation income loan that you'll see out there in the market today, unless you're going true hard money and it's an equity play. What a DSCR loan is, it is a way to prove income on investment properties only, guys. Let's put a little asterisk near that. Investment properties only for a DSCR loan. Why? Because we're using the income of the investment property. I don't care where you work. I don't care if you have a job. The only thing I want to know, can the rent cover the bills of the house? If it can, and you have decent credit, and you have a down payment, I could put you in the house. Now, those loans, obviously, they won't go as high as a loan to value as an FHA or a primary residence or a second home. They still have to put 20% down, which is even the cap on conventional. But again, it's still an aggressive product. You do not need any tax returns. You only need to prove you have the down payment, a couple of months of reserves, only 3 months, emergency funds, and you have a credit score. And I'm talking, you only need a 660. What we do to prove income, we order a market rent analysis from the appraiser, and that'll tell us, okay, 123 Mockingbird Lane, average rent for that is $5,000 a month. That is what I'm using. So if that covers the mortgage payment with the principal, interest, taxes, and insurance, we have ourselves a loan. Okay? Then you have, again, up until recently was a more popular product, fix and flips. All right, so again, just like what it sounds, it's a acquisition money coupled by a construction loan. So what we do is we give you money to buy the house, give you money to fix it, and then you can flip it. So that is the non-QM world, guys. Again, it's our most popular products by far right now. The interest rates are not much higher on most of these loans with the exception of fix and flip. It's almost like not a hard money loan like a lot of people call it, but it does have a higher interest rate. It is, again, sort of the outlier of the group, but those other three, bank statements, profit and loss, and DSCR, those rates are very, very comparable to conventional. So people are they're not afraid to take these loans because, again, it's getting them in the house. You're not getting, truly penalized for not using tax returns. Of course, they are slightly higher, but again, it is getting self-employed people in the house, and that's what we're about. We're about helping people, expand their portfolios, create generational wealth, other income. You'd be surprised if there's anybody, I know you guys do a lot of business loans and other loans. You'd be surprised if you start probing how many houses a lot of these business owners own. We'll get an individual that has a trucking company. Before you know, he's like, yeah, I have 3 rental properties. Can you refinance them? So it's actually pretty good for them to get into these products. On to the next slide, Tyler. So a couple of key highlights, guys, for the government loans and the conventional loans. Okay? If you're not putting down 20%, always requires mortgage insurance. Maximum debt to income ratios on FHA's 56, conventionals 50. Maximum loan to value 96.5 on a purchase and rate and term. Primary residence is only for an FHA. Okay, you can get 97 on conventional on a purchase. If you're looking for cash out, they're both capped at 80. Minimum credit scores: FHA 580, conventional 620. Good thing is now you get something called the seller's concession. That is a way on a purchase to roll in the closing costs. All right. Now keep in mind, team, they're always full documentation of income. Full documentation of income requires tax returns, pay stubs, and W-2s. Obviously, I could cut down that paperwork if the underwriter deems so. Sometimes you only need just the W-2s and 1 year's pay stubs. When we run it through, which is our form of AI, which we've been using for at least a decade now in the mortgage industry, something called desktop underwriter, all right, which we'll go over in a second. FHA, more lenient credit requirements on FHA loans, lower credit score, have a couple of lates here and there, but you can't be, sub 500. You can't be in bankruptcy. You can't be out of bankruptcy for only a year. They do require 3 years out of bankruptcy for FHA, 7 for conventional. Okay. Now, FHA and conventional both have loan limits. All right, those limits depend on county. Conventional, for single family is roughly $1 million. The more units you add, the higher the loan amounts go. All right. Loan limits vary by county. So your county in Florida, certain counties like Manatee and some of them are not going to have as high a loan amount that you go like in New York or high cost states, New York, Hawaii, New Jersey. Obviously in Florida, there are a bunch of parts, that whole southern tip, the whole southern Miami, Delray, Miami, all those counties, Broward, they have the higher loan amounts because of the higher cost of living. All right. Now, what I was talking about when you see in the bottom right here, must pass something called the desktop underwriter. What that is, it's a pass-fail system, and it lets the underwriter know, okay, we only need X. So, for example, I may collect all the tax returns up front. I run it through desktop underwriter. They may say, you know what, Manny, we only need 1 year's tax returns and a letter from their accountant that they are self-employed. Or same thing with if they're W-2'd. We could say, all right, we only need pay stubs in the last year's W-2 and they're good to go. Don't worry about the tax returns. Happens half the times, but we always ask for that documentation up front. All right, now a couple of things I want to say, team. When it comes to scenarios, always run them by us because you never know what we could do because there's always different programs. There's always guidelines changing. I'm always going to ask that borrower a million questions and probe a bunch of different ways to see if there's other income, if there's an ADU, stuff that I've just acquired over many years of just doing it that we may be able to get them in the house. A lot of times, as long as they have decent credit and some sort of income, it's not a matter of if we can do it. It's just a matter of how much I can get them approved for. So it's again, a lot of times, like I said, it's not if it's a no. It's hey, I can only get you 200,000, or I can only get you 500,000. Can you find a house for that? So that's a lot of the times what the scenario is. But again, guys, I know we go through this fast. We just wanted to give you a rough idea of what we do. In the upcoming weeks and months, we're going to switch on and off between business loans and mortgages. And then each segment, for example, the next time I want to go over a DSCR loan, because a lot of business owners are buying houses. They don't care what the rates are. They're more the savvier borrowers that know they can always refinance and that there's good deals on investment properties because rents are still very high. Next slide, please, Tyler. So as you can see, guys, that's how you can contact us. You can scan there. We'll leave that up for a little while. That'll give us all the contact information to myself, Merchants Property Solutions, email addresses and whatnot. You guys, you don't need a formal appointment to get it with us. I know a lot of you have seen Nick on some seminars, and other people here, Steve. Again, you can get in touch with any one of us with any scenario, and then we'll put it in the proper department. You don't need a formal appointment. You don't have to wait days. The longest is a couple of hours till we get back to you, but usually within the hour we can get back to you. Again, guys, with that being said, let's start the Q&A. Nick, what do we have in there? Not any questions. Okay. Anything on Instagram Live or anything? Okay. So, as far as questions, guys, so a lot of questions I get, what states are we good in? When it comes to investment properties, gloves are off, as I like to say. We do not need to be licensed in that state as a bank. We just need to have a license in another state. It's almost like reciprocity. So since I'm good in New York, I could do licenses in all 50 states and the District of Columbia when it comes to investment properties. When it comes to primaries and second homes, you need to be licensed as a loan officer like myself, and you need to be licensed as the bank. So for example, if you find a primary home in Mississippi, or let's say South Dakota, I'm not licensed in either one of those states to do primaries as a bank or as a loan officer. If they're buying an investment property in Mississippi, I don't have to be licensed as a bank or loan officer, and we can do that, okay? Because they're considered business purpose loans. So they don't follow what's called TRID. For some of you who are familiar in the real estate world, TRID is the guidelines for fees, when disclosures need to go out, how much you can charge, what can be charged, notifications, a bunch of dates to follow. We follow that even on investment properties, even though we don't have to, just because we are a licensed entity. We do FHA and conventional loans. We are scrutinized a little bit more than somebody that just is your investment properties. So that covers the states. Documentation. Listen, guys, it's different for every loan. So when you call us, how the process is, you call us, we go over it with the client, all right, and we're very involved. We'll tell you what to ask. We'll do a discovery call, as I like to say, and then we as the bank will send out a list of documents that are needed specific to that deal. Because, for example, if they have a bankruptcy, it's going to be different stuff. If they had a divorce, if they have a late, I could tailor all my team, because again, guys, we're not a one-man band. You can't see the office behind the camera here, but we have, 15 loan officers, 5 processors, accounting, the whole nine. That helps me while I'm doing stuff like this and to work with you guys. So we will tailor each one through our portal to make sure we have everything we need for the deal and to make sure it goes smooth. And again, every deal is different, guys, depending on where they work, how they work, employment, how long they're there, type of business that they do. That is why we send out everything specific. And again, if you want to handle the file, you can. We prefer to because, we're going to hold your hand through it, but it just makes it go quicker and smoother if you just get us involved. All right? What else should we cover, Nick?
Got one. It says, how much do I need to know to submit referrals to you?
Okay, so here's what I want you guys to do. I don't want you, and I don't know, I like to use the deadliest catch theory. I watch it, I like it. They take everything in and they throw away the small ones. What I need to know, we need to know there's an interest. We need to know they don't have like a sub 500 credit score. And we got to know that they know we're going to call. Because a lot of times there'll be some people that'll send us a deal. Somebody just met online, at the grocery store. They said, "Oh, I might want a mortgage." They're not knowing we're calling, not knowing anything. So we need interest. We need a decent credit score, and they gotta want to be buying a house or refinancing. As far as documents, we will tell you what we need after we do that phone call. I'll email you quick. We do a lot of three-way phone calls, a lot of conversating in the initial phone calls just to get it done. If you guys haven't done mortgages before, if you have, listen, I'll just shoot you a list. We'll let you handle the client. But again, as far as documentation, just find out there's an interest there. Ask a couple qualifying questions, which, Nick, we can send out a group email, right? Qualifying questions. So we'll send out qualifying questions of what we need just to say, hey, it'll only be like 4 or 5, and then we'll take it from there. Again, most important things, decent credit, ready to move, not looking for 150% financing because we don't do that. Stuff like that. Not looking to do construction of $200 million. Again, guys, stuff that's just outrageous that probably can't do anyway. That's the other one?
Second one on the bottom.
What is the typical time to close each product? Okay, so fix and flips will be the fastest close, 3 weeks. And again, depending on the loan, if it's commercial takes 60 days. Our average close time right now with all products encompassed is 30 days. From when we order the appraisal and disclose the file to when it actually closes. All right? Again, and depending on the borrower. As usual, the more motivated the borrower, the quicker the file goes. So if the borrower is motivated to close faster, but our average close time, no matter what the file is 30 days.
What options do you have to help people get their credit up if they can't qualify as it stands now?
So we could do a couple things. I could do a quick analyzation. If their credit is low, just due to utilization, for example, we have a lot of borrowers that might have only a $4,000 or $5,000 credit card that's at $4,200 that they just pay the minimum payments, not that they can't pay it. That could drop a credit score 50 or 60 points. That could bring your 580 easily to a 620 by paying it off. So if it's something simple like that, we can analyze and it's strictly utilization. We could take care of that. When the borrower does it, we can do something called a rapid rescore. When it comes to more intricate stuff, like they just had a bankruptcy, stuff's reporting late that it's not to. I do have a couple of credit repair people I do refer them to. But listen, to me, credit repair can be tough. It is getting better as the years goes on because of the flow of information. But we can analyze what's wrong. We can see what needs to be done. And we can tell them, hey, your credit needs to go up. Speak to this one. They'll help you with your credit score. And again, or if it's utilization, that's something we can handle ourselves. So we do hand-holding if the credit's low, and we do a plan of action for them depending on why the credit is low.
Manny, next question that just came in. Are you able to handle loans on a national level?
Yes, we are good. Like I said, national level, we could do all 50 states if it's an investor property, and we could do 38 states plus the District of Columbia if it is a primary residence or second home. And guys, keep in mind, though, those 12 states that we can't do are states that, in all honesty, have more cattle than they do people, like your North Dakotas, your South Dakotas. Ton of properties, there's ranches. The acreage is huge. That's the places that we do not do loans in. So the business there is scarce. Maybe turn 1 or 2 loans away out of there. The only 2 states I feel that hurt me is Massachusetts And believe it or not, Mississippi, because a lot of people are going, to Mississippi. Taxes are low, business good there with trucking for what I hear. Those are the only two states that hinder us. Other than that, California, we do from coast to coast. Our board, is all over the place when it comes to loans. So on a national level, yes, our coverage is on par.
All right, and Manny, can you share any success stories with other partners, other referral partners that you've been ultra successful with over the years?
Do you want to stick around till 6 a.m. tomorrow?
Yeah.
Tons. So I'll give you an example, guys.
And what gives what separates them from the ones that, do onesies and twosies? Where the bulk of the success come from?
Our self-employed product,
Repeat the
Nick.
question, by the way.
What happened?
Try to repeat the question.
So when it comes to success stories, that person that, listen, when it comes to your money when you're self-employed, people, it's not what you make, it's what you keep. A rich guy told me one time. So the less you pay in taxes, you're considered more successful, which is understandable. It's the American way. Business owners write this stuff off. But sometimes they can't get that $2 or $3 million house that they want. And that's where we step in. We're able to get them those bigger houses, the houses that they want, or investment properties without going off their tax returns. We have tons of success stories every month. I'll give you an example. A little pizza store here in Hop Hog. The guy really wanted a bigger house. He was saving cash because he felt he had to pay cash because where he banks with Chase, they keep saying, Mr. Tony, you're no good, you're no good. Not that you're no good, you beat up your tax returns. We used his bank statements. He had 3 pizza stores. He deposits about $250,000 a month between 3 pizza stores. And we put him in a $2 million house in the water on here in Bayshore. Why? Because we didn't go off his tax returns that said he made $15,000 for the year. We used his bank statements that did $250 a month. And we said, okay, your business is doing $250 a month. I'm working your debt to income ratio off of $125,000 a month. So if I'm giving you $125,000 a month as income, there's not too many houses on paper you cannot afford. So I think that's a pretty cool success story. Again, getting self-employed people who think they have no alternative to get into a house because they're told no by the big banks. We're getting them in. Like I said, guys, it's not a matter of if I can do it. It's just a matter of how much I can get them. And that's what makes us successful. That and our speed and the fact everything is in-house and we have a great team behind us. I'm only as good as my team, and we have a great team.
Can you share a little bit about how it works with the referral partner? How are they compensated for this type of stuff? Obviously, we're all in this to refer business, but we also want to make sure that we're being compensated as well.
Correct. You guys are deemed marketers in the eyes of the law. Okay? So marketers get paid for their leads. You're not getting paid for success. We're paying you for referring that lead to us. Okay? And you are compensated. It's as you should be because you're doing half the work by getting us the loan. So we're doing the other half and paying for the office bills. So that is how our system works. And we're giving a tool that a lot of people didn't think they have access to, which is mortgages. The debt service loans are considered business purpose loans. So it's very easy to work out a compensation plan. Because again, we're doing all the work. We're talking to the client a lot, guys. We have to because we're licensed. So that is, again, what's making us successful. That's what's able to give us referral fees. That is what is enabling this whole program to work. We are handling the client. We're speaking to the client. We have to, by law. It's my license. It's the place license. And no offense, we don't want to, we don't want to ruin that just to pay somebody. So we do protect ourselves. And again, it's a successful program. I love cutting checks because that means we close loans.
Awesome. And Manny, so that means the referral partner doesn't necessarily need to be licensed in order to send deals over.
Correct. He just needs to know how to market and talk to people. Or she.
Great. So why don't we thank Sean?
Yes, Sean, I thank you. I haven't met you personally yet, but I do thank you. Nick, is always raving about the group. He says you guys are probably our best group yet. And I'm looking forward to it. Nick is always dead on, so he's a very good reader of people. And if there's no more questions in the chat, guys, I will say this. Don't hesitate to reach out. Don't think it's a silly question. Be aggressive. That's what we're here for. If you can't get me and we hand you off, not hand you off, but if somebody else answers the phone, they're just as knowledgeable about the mortgages or the business loan products as I am, if not better, because they're doing more of the day-to-day. Again, I'm not the Prince of England. You don't need a formal appointment to get us. You don't need to do on this. Email, text, whatever you need to do to get in touch with us. If I don't answer, Nick will answer. You have Jordan, you have James Bonfanti, you have, I call them the kids because they're half my age. John, I can't even name all of them. There's a ton of people here, guys. Like I said, we're a strong team, and the ones who are most successful are the ones that are reaching out and bringing scenarios. Okay. With that being said, any more questions? All right, guys. I want to thank everybody. The next call Money Monday, Mortgage Monday will be 2 weeks from now. We'll send out another email. If you guys want to email us a topic too that you want us to go over, whether it's on the business loan side or the mortgage side, we can go over that if everybody wants to. If not, I'll pick them. But again, once you see that email with on there, if you say, hey, I'd like to learn about this, and if we get enough people saying the same thing, we will switch to that product and we'll jump the line to that product. Again, wanted to thank everybody, Sean, the whole Aspire group. Speak to you all soon. Look forward to working with you guys, and thank you very much.